Hey, good day, everyone. Welcome to our webinar. My name is Bert Salazar, and I am going to be your host this morning. This is an abbreviation of the Taxes and Retirement seminar that I do on a monthly basis at FIU, which is Florida International University. And this is primarily for those of you that register for the event and couldn't attend. You know, at the end of the day, life has a way to get in the way from time to time. So for those of you that registered, but you couldn't attend for one reason or the other, this is a great way for us to bring you the information that we provided for the vast majority of those that attended the FIU webinar this week, and that do so on a monthly basis. Again, as I said, this is going to be an abbreviated version. Usually the ones that we do at FIU, especially the ones that we do on a Saturday morning, we do a much more deep dive into the taxation and retirement and all the different things that you can do along the way in order to avoid the taxation of your assets when it comes to your retirement income, your cash flow, and your retirement distribution planning. Again, my name is Bert Salazar. I can see that more and more people are logging in. We're almost at 9 a.m. Eastern Standard Time, so I'm going to give it another 30 seconds, and then we're going to get going, because at the end of the day, I don't want to waste the time of those of you that logged in on time. So I want to make certain that we can give you as much information and that I can give you as much information as possible. What is interesting to note is that we only have an 8-year window in which to do proper tax planning. And for the vast majority of Americans, and I would also argue for those of you that are listening to this webinar today, you have already missed one of those years, which was 2018, under the new tax law, which is the Tax Cuts and Jobs Act. So we'll talk a little bit more about that, but you only now have a 7-year window, because for the first time in US tax history, we actually know when taxes are going to go up in the very near future. So let me see, we have quite a few people that have already lined up and signed up. So let me go ahead and share my screen with all of you. And you should be seeing my screen in the next few seconds. Let me take you right down to the presentation that we're going to be using. And here we go. So again, this is based on the FIU workshop, and this is an abbreviated version. As a matter of fact, what I call this version of the webinar is how to avoid the torpedo tax in retirement, or how to legally, and I mean legally, divorce the IRS in retirement. If you can do that, then your financial life in retirement is going to be in a much, much better position than if you're not proactive with your tax planning approach to your retirement distribution plan. A disclaimer that is important to use: although I am a tax preparer and a tax planner, I don't work for the IRS, and I definitely don't work for Social Security Administration. Those of you that are working with other advisors, make certain that you visit with them. And if for some reason those advisors do not have the educational capability or the capability of helping you with tax planning, then at the end of this webinar, I'm going to give you my personal information, and you can feel free to reach out to me for help along those lines. Now, I'm going to have to go fairly fast because I don't want to keep all of you here. I may be spending a little bit more time in some of the slides, but in others, I'm going to go fairly quick. I'll also bear in mind that these types of webinars and workshops, they're 2 parts in nature. So, we'll talk a little bit more as we go along. This webinar, the workshops that we do are sponsored by SOFA. SOFA is the Society for Financial Awareness. I'm a very proud member of the organization, and I'm very proud to be part of SOFA because the #1 goal for us in providing education is to kind of try to eliminate financial illiteracy throughout the United States. SOFA events are being held on a daily basis almost throughout the United States and Canada, and many times we do them at colleges, universities, which is basically what I do. Also, Fortune 500 companies and major corporations call us from time to time in order for us to create a financial literacy program for their employees. So we do have the ability to come into those employers and do long-term workshops, which we're providing an array of different educational pieces to their employees in order to assist them in making better decisions for themselves and their families when it comes to retirement preparation and retirement planning. Many a times, especially in my case, a lot of the business that we do here in my firm, we do online. So from time to time, once a month on a Saturday, I try to provide these types of workshops through a webinar video system in which you can log in from the comfort of your home, the comfort of your office. By the same token, I also record these webinars. So even if you're not able to attend, then I will send you a follow-up with a recorded version. And then obviously you have the ability to watch it at your convenience. So again, SOFA is a major 501c3 nonprofit organization, and I happen to be their key member here in the South Florida area. Now, today's webinar is going to focus on four major things. Number one is understanding the new tax law that came into effect January 1 of 2018. Number two is how to understand the impact of that new tax law when it comes to your retirement planning and your retirement distribution planning. We're also going to share some ideas on how to identify tools and strategies that are available for you to minimize and/or eliminate your tax liability in retirement. And last but not least, we're going to stick to the actionable. We're not going to get into the political, because at the end of the day, both political parties are guilty of all the things that we may be discussing today. Now, there are some commonalities that I want to share with you. Obviously, we try to make this fun. So the first one is, you know, what's a commonality between tax planning and a colonoscopy? Simply speaking, nobody wants it, but everybody needs it. So if you don't do tax planning, at least over the next 7 years, chances are your retirement distribution planning is not going to be as feasible, it's not going to be as strong as it could have been had you taken the time to do proper tax planning. The second commonality I want to share here, and this is sadly one of the ones that I see often whenever I do audits for new clients who are coming into our firm, is the sinking of the Titanic concept. For those of you that may not know this, when the Titanic sank, obviously over 1,500 people perished and died on the sinking of the Titanic, but there's actual filming of employees at the Titanic rearranging the chairs on the Titanic after it hit the iceberg. And the sad thing about that, when you apply it to the financial and to the retirement world, is that many of the clients that I engage for the first time have been rearranging the chairs on the Titanic, on their financial Titanic, for many, many years, meaning that they follow the definition of insanity, which is doing the same thing over and over again while expecting a different result. So you have to be able to make paradigm shifts in order to better yourself and your family when it comes to retirement distribution. And then the last commonality has to deal with the fatal four of retirement. Whenever we do any type of tax planning, we're always looking at it through a risk perspective and a risk avoidance perspective. So if we can help you avoid the fatal four, then we've done a very good job. And then you have done a very good job, not only for yourself, but also for your family along those lines. What are the fatal four in retirement? What are the four major risks that all of you are going to have to deal with at some point in time? Well, number one, the risk of dying too soon. No one ever dies at the right time. What impact is that going to have on your family members, on your surviving spouse? Now, in our traditional seminars at FIU, we go deeper into this, but here on this webinar, I'm just going to share what the concept is, and then if you have additional questions, you can feel free to reach out to me later on or at the end of the webinar. The second risk that we always try to manage for our clients is the risk of living too long. Because of longevity, And because of medical technology, people are living a lot longer today than ever before, especially in the United States of America. So if there's one thing you don't want to do is you don't want to run out of money before you run out of life. So you need to do something in order to protect and create guarantees for yourself and your family when it comes to your retirement cash flow. The third risk has nothing to do with dying too soon or living too long, but it does have to do with living with a disability. And the challenge is that the longer that you live, the higher the probabilities of disabilities and long-term care for you and your family. As a matter of fact, if you're married, filing jointly, and you're 65 years of age, and you're fairly healthy, there's a 70% probability that one of you or both of you is going to have a need for long-term care. And the cost of long-term care today is actually increasing at almost 3 times the rate of inflation. And then last but not least is the risk of eroding factors. And eroding factors is anything that can erode the value of your money in retirement. So taxes, inflation, stock market volatility, interest rate volatility, lawsuits, propensity to consume, life happens events. Those are things that are going to be eroding the value of your money. So the better you do in minimizing tax and inflation liabilities and stock market volatility and interest rate volatility, the better off you're going to be when it comes to your retirement needs and objectives. Now, thought of the day, and this is a very critical one that all of you should pay attention to. And this is a quote from a very famous president of the United States. And he said that the problem with our tax system is not that Americans pay too little. The problem with our tax system is that government spends too much. And the person who said that was the 40th president of the United States, Ronald Reagan, and he said that obviously north of 40 years ago. And that is that was as true then as it is today. The one bold promise that I'm able to make to all of you in this webinar today is I'm going to be able to help you increase your retirement income while reducing your tax liability. If you follow the steps I'm going to share with you today, you're going to be a lot better off tomorrow than you are today. So obviously you're going to need someone to hold your hand to walk you through it. But at the end of the day, if you're able to do this, then you're going to be very successful in your retirement plan, regardless of the amount of money that you have set aside for retirement. Okay. This just got stuck for a second. All right, perfect. The seminar platform that I'm going to share with you today has 2 parts. The first part is the education, and this is what I'm bringing to the table to you today. And then the second part, if you want to apply some of the concepts that I've talked about, and you don't have anyone else, or the person that you've been using does not have the capability to do it, and you want to engage me on a one-on-one basis, you're going to have the ability to do so. Because we're doing this through SOFA, there are 2 reports that I have to be able to do for all of you if you do wish to move forward with a confidential strategy session at no cost or obligation to you. One would be the tax planning report, which is going to help you maximize your tax liabilities or minimize your tax liabilities in retirement over the next 7 years. It's going to give you the ability to do a lot of things that otherwise you wouldn't be able to do, because you would know what your tax liability would be. And then the second report that I'm obligated to do for those of you that may want to engage me on a one-on-one basis at no cost or obligation would be your Social Security report, which is going to give you the ability to determine what would be the optimum time, not only from a cash flow and income perspective, but also from a tax perspective, what would be the optimum time for you to go ahead and sign up for your Social Security benefits. Now, who am I? I'm a certified financial instructor, so I'm not going to go much into that. We can have that conversation if you want to move further along those lines. And the first thing that I want to share with you is what would you consider to be a perfect retirement plan? And I'm sure that many of you on this call have given this perhaps a little bit of thought, but very, very few of you have actually given this your total thought and concern when it comes to preparation. What you will find is that most Americans spend more time preparing for a vacation than they do for retirement, because they think that retirement is easy. They think that when they get to age 60, 65, 70, whatever the age may be, they're going to have all the assets in one pool, and then they're going to start taking money from those assets, and everything is going to be well and good. Well, it doesn't happen that way. Retirement distribution planning is very complex, and it's something that you got to pay attention to. So if you're going to be drawing a perfect retirement plan, this is the way it should look like. You should have guaranteed income. That income should last you for a lifetime. That income should have some inflation hedging, meaning that you want to make certain that your annual retirement income stays ahead of inflation, or at least with inflation. You want to have as much tax-free income as you possibly can. Also, you're going to want to have some long-term care hedging in case you happen to be one of those victims, or one of those 70% of Americans who are going to have a need for long-term care. And then last but not least, you want to make certain that your retirement plan provides survivor benefits for the surviving spouse at some point in time in the future. Now, one of the analogies that I try to make with many of the clients and many of the attendees to the workshops that I do is, what is the goal of a mountain climber? If you wanted to climb Mount Everest, what would be the goal? Well, I would argue that the vast majority of attendees and clients that I ask the question for the first time, their answer is always the same. The goal of any mountain climber is to get to the summit, to get to the top of the mountain. I would argue that's only half of the goal, because you want to make it back down the mountain safely, so you can tell the story to your family and your friends. What's interesting about this analogy is that retirement is the same way. I've been doing a lot of reading over the years regarding Mount Everest, and Mount Everest, for those of you that may not know this, sits at 29,029 feet. Also, 70% of the people that have actually died on the mountain have not died on the way up. They have actually died on the way down. So if you start to equate climbing Mount Everest to retirement, as you're climbing the mountain, that would be your retirement accumulation years. You're working, you're putting money away in your savings accounts, your investment accounts, your 401ks, your retirements, your pensions. Perhaps some of you may be doing real estate and you're putting money away. You're worried about the amount of money that you're putting away, the rate of return that you're obtaining on those assets. Also, you want to make certain that longevity is going to be playing on your side, because you want to get to the summit. And the definition of the summit would be that year in which you're going to retire, whether it's going to be 60, 65, 70, or any other year in between. Now, once you get to the summit, you're going to start coming down the mountain on the other side of the mountain, which would be your retirement years. The challenge is that Americans have been saving for retirement, and they have been on the accumulation years for so long that they're not able to understand how distribution takes place. So they're all about accumulation and nothing about distribution. When you get to the summit and you start coming down the retirement mountain, you have to be able to make a paradigm shift where now you're going from accumulation to distribution. And the rules of engagement totally change. When it comes to the distribution of assets, you're more concerned about the distribution rate than the accumulation rate, as you had been for many, many years. Most important, taxation, inflation, stock market volatility, propensity to consume, long-term care issues, and survivor benefits are going to dominate your ability to come down the mountain. And most important, if there's one thing you want to avoid, is you want to avoid running out of money before you run out of life. What normally happens on Mount Everest is, as people are coming down, they're actually running out of oxygen. And in the financial world, it means that you're running out of money, which forces you many different ways. And thank God for Walmart. But you know, see how many 85-year-olds you see at Walmart greeting you as you walk in. That's something that you don't want to do for yourself or your family. So having the ability to plan your retirement distribution suitably is very, very important, not only for you, but for your family as well. Tax Armageddon, just take a look. I mean, that's something that you can pull up on the internet, but if you look on the left-hand side, we're fast approaching $23 trillion in national debt. As a matter of fact, for the first year in 2019, we're actually running a deficit of $1 trillion every year. And if you look at the bottom toward the center of the page, you are going to notice that the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare, Part D, interest on the national debt, meaning unfunded liabilities are all the promises that the US government has made to all of us, but they don't have the ability to keep, and they don't have the money to keep. They're now reaching $126 trillion and counting. So for those of you that think that you're going to be in a lower tax bracket in retirement, the only way you're going to be in a lower tax bracket in retirement is if you're a financial failure in life. And if you're on this webinar today, or if you attend one of my seminars, then your number one goal is not to be one of those. So I'm here to help you along those lines. Now, if you take a look at the tax history in our country, what you will find that other than the period of 1913, which was a very, very beginning of the IRS code, and then that small period there during the Great Depression, we're actually living in the third lowest, if you go to the far right, in the third lowest taxation in US history. So we have historically high debt and historically low taxes. Where do you think that taxes are going to be in the future along those lines? By the way, for those of you that may not know this, we already know when taxes are going to be higher. Taxes will be higher January 1 of 2026. So you better write this down. January 1, when we all wake up on January 1st of 2026, taxes are going to be higher than they were on December 31st of 2025. And the reason for that is very simple. The Tax Cuts and Jobs Act sunsets, ends, terminates December 31st of 2025. So taxes are going to get a lot worse as soon as you hit January 1 of 2026. Now you hear all of these political pundits on both sides of the aisle talking about raising taxes for the wealthy and so forth, and that's all fine and good if you think you can do it. But at the end of the day, there are not enough of them to be able to take care of all the national debt and the unfunded liabilities and the deficits that we have in our country. So at the end of the day, there's always 40% of the population that does not pay any taxes. So the vast majority of any tax increases are going to have to be absorbed. If you do the math and if you do it properly, it's going to have to be absorbed by the middle class. So if you don't think that your taxes are going to be higher in the future, then I have some news for you. And if you do think that taxes are going to be higher, then you have a great probability of doing some tax planning and capability of doing tax planning between now and the end of 2025 in order to make certain that your personal taxes do not increase and that you actually have the ability to reduce those taxes as you move forward into the future. Now, I want to use a couple of disclaimers. Number one, those are not my parents. And number two, my parents never used an Apple laptop, but that's exactly how my parents looked when they started to look at their retirement distribution planning. Now, obviously, they had a son that was a tax planner and had an accounting background and had been in financial services for many years. So I was able to accommodate them and get them prepared for retirement. And they had an excellent retirement until that point that they both passed away. By the way, my parents actually passed away within 8 months of each other. So, you know, that's something that often happens, especially for people that have been married for many, many years. Now, this is a new tax laws you see today. You see that this is a progressive system. So as you make more and more money, your marginal tax rates are gonna go up. Notice that if you see there, the 12% used to be the 15%. So that now under the new tax law, the 12%, the 22%, the 24%, the 32, 35, and 37, those are the marginal tax brackets that Americans are dealing with today. Now, prior to January 1st of 2018, there used to be the 15, 25, 28, 33, and 39.6%. So those are the same rates that will take effect January 1 of 2026. So for those of you that wake up, and for those of us that wake up January 1, those are the new taxes that we're going to have to pay. What's going to be even worse than that is that the standard deductions will go back to the old law. So now the standard deductions will be lower while the tax brackets will be higher. So the compounding effect of that is that all of us, and most of us, are going to be in a higher tax bracket January 1 of 2026 than we are today. Now, obviously, this is the map of what I just went through with you. Notice that the one thing that we try to avoid from a tax planning standpoint is those big jumps in the marginal tax rate. So from 12% to 22%, and then from 24 to 32, we want to try to avoid those. And the only way you're going to be able to avoid those is by utilizing tax planning techniques. Now, capital gains brackets, they work a little bit different, as you know. Capital gains pay a lower tax than ordinary income rates, and the reason is simple. The IRS and the US government is willing to give Americans certain tax breaks if they're willing to invest in the US economy. So whenever you take your personal assets and your personal funds and you invest it into the economy, whether you're buying a stock or whether you're opening a business or you're hiring employees in your firm, obviously you're helping the economy overall. So therefore, the IRS says that if you have any capital gains, any money that you've made that is considered and privy to be a capital gain taxation, then the rate is going to be lower than ordinary income because you actually put your money at risk. So from 0 to 77,200, if you have those in capital gains, your tax liability is 0. Compare that to the ordinary income tax bracket, you would be at the 12% tax bracket. And then obviously from 77,000 and change to 479,000, you get into the 15%. And then anything north of that, you end up in the 20% tax bracket. One of the encouragements that I make to a lot of my clients is to try to have as many capital gains assets as they possibly can, because you're automatically reducing tax liabilities in the future. And then obviously this is a map and how it looks the same way. The other thing is short to cover here that I spend a little bit more time in the seminars is, you know, the difference between deductions, exemptions, and credits. What I can tell you in this short webinar is that, think of it this way. Deductions and exemptions will reduce your taxable income. Your credits will reduce your tax liability. Credits are those credits that the IRS government has given to all of us in order to incentivize behavior. So if you get a saver's credit, that means that, you know, you're putting money away for your own retirement, and the government is willing to give you a saver's credit of $1,000 on your tax liability if you can show, you know, after the age of 65 that you continue to save money for retirement. If you have children, interesting, if you have small children, your children are not only an exemption, but they're also a credit. And now the credit for those children have doubled to $2,000. So there are some benefits. The deductions, obviously, your standard deduction. If you're married filing jointly, your standard deduction just went to $24,400 for 2019. And you could see that the exemptions that we were able to claim in 2017, they went away. If you may recall, for every person that was alive, you could have claimed a $4,050 exemption, which meant that a husband and wife would have claimed $450 each, $4,050 each, for a total of $8,100 plus a standard deduction. Because of the fact that the standard deduction has increased dramatically, then they did away with the exemption as well. If you're married filing jointly for 2019, once again, your standard deduction will be $24,400. Plus, remember, you're living with the lower tax brackets that we just covered. If you're filing single, your standard deduction will be $12,200 as well. So it'll be double than what you had in 2017 and a little bit more than what you had in 2018. Now, if our tax system ended here, then obviously all of us could do our taxes ourselves, but there are so many other things that we need to pay attention to, especially as we get closer to retirement. So we'll talk about some of those in the next few minutes. One of the major ones that I deal with just about every day deals with what is known as R&Ds, and these are your required minimum distributions. If you have money invested in 401ks, IRAs, 403bs, any type of pension, any monies that you have invested in the tax deferred bucket, which means that the money goes in pre-tax and money grows tax deferred, and when you pull the money out is tax free, the IRS has placed certain guidelines on how you can use those dollars. If you're putting money in a 401k and an IRA, if you take money out prior to age 59 and a half, there's a 10% premature distribution penalty. Now, if you're in a 401k, you could borrow the money, but that creates all kinds of other issues and double taxation. So I'm always letting my clients know that they should avoid borrowing from their 401ks as much as possible. Now, between the ages of 59 and a half and 70 and a half, you can do anything you want with your qualified plan money. You can take money out 1 year. You don't have to take it out the next year. You have a lot of flexibility. Actually, when it comes to qualified plans, IRAs, 401ks, 403bs, etc., you only have an 11-year window in which you can pretty much do anything that you want with your assets. Other than that, you have all kinds of guidelines, restrictions as to how to use the money and when you can use the money. The bigger one of those is once you get to the age of 70 and a half. If you turn age 70 and a half in 2019, whether you want to or not, whether you need the money or not, you're going to have to start taking out of these qualified plans what is known as required minimum distributions. And if you don't take them, there's going to be a major penalty, and we'll discuss that as well. Now, again, this will come into effect at the point in time that you reach the age of 70 and a half. So if you reach 70 and a half in 2019, you will have to look back to the end of the year in 2018. In other words, all your retirement account statements in your IRAs and your 401ks as of December 31st of 2018. And then you're going to have to use a formula and apply that formula that the government gives you against the final balance as of 12/31 of 2018 in order to determine what minimum required distribution you should take for 2019. And the way that you do it is as follows. Let's say that you had $500,000, $500,000 in your retirement accounts as of December 31st of 2018. Then under current law, you have to use a formula which is 27.4. It's a ratio there. So you take the ratio of 27.4 and you divide it by $500,000, and now your required minimum distribution for 2019 is $18,248. Now, most of you may not know when you're going to die, but the IRS does. So basically what the IRS does, as you can see there on the left-hand side, that if you're age 70 or age 70 and a half, then you have to take you have to be able to spend your money over the next 27.4 years. So that's why you take that rate of 27.4, and then you divide it by the value of the account as of the previous year that dictates how much money you have to take out of your required minimum distributions. The question is, well, can you take more? Absolutely, you can always take more. But if you take less than that, then you're going to have a major, major penalty. And the penalty is that whatever money you're supposed to take and you don't take, then you're going to have to pay a 50% penalty plus taxes on that distribution. So let me give you an example. Let's say that my required minimum distribution is $10,000. And for some reason, I forget to take it or I don't take it. Well, the excise tax penalty for not taking under the required minimum distribution rules for not taking those $10,000 would be $5,000 in penalty. And then if I happen to be in the 20% tax bracket, I have to pay 20% of those $10,000 that I didn't take that I should have taken. So that would be an additional $2,000. So if you don't do this right every single year, then in my scenario, that $10,000 distribution, you will end up with $3,000 after paying $7,000 or 70% in taxes and penalties. So I do encourage each and every one of you to pay a lot of attention to this. Another major issue is that, well, Bert, yeah, we do get a notification from the financial institutions when we turn 70 and a half. Do I have to worry about anything along those lines? And the answer is yes, because depending on what kind of a plan do you have, what kind of retirement plan, you may have the ability to take that distribution, that required distribution from each and every one of them, or you may have a choice to take them from just one and accommodate for everything else, or a combination of both. So there are all kinds of rules and regulations that you need to abide by and you need to be made aware of. One of the major ones is if I turn 70 and a half this year in 2019, and either one of you, and some of you do as well, then the IRS, for the first time that you reach 70 and a half, they're going to give you a choice. And the choice is you can either take the required minimum distribution in 2019, since you turned 70 and a half, or you can delay that distribution until April 1st of 2020. And the big question I often get, Bert, which one of the two would work the best? And the answer is, it depends. Depending on your tax liability, depending on the tax forward planning. And this is something that I do with each and every one of my clients once they hit the age of 70 and they're 6 months away from hitting 70 and a half. And then we determine whether it makes sense to take it in the year that they turn 70 and a half, or do we wait a little longer? Most of the time, it may be more suitable to take it in the year that you turn 70 and a half, because if you delay taking that 70 and a half distribution until April 1st of the following year, then the following year, not only would you have to take that previous year RMD by April 1st, but you will also have to take that current year distribution by December 31st of that year. So you may have to pay taxes on two distributions as opposed to one. Now, if your income in 2019 was much, much greater than the income in 2020, then it may be suitable to delay, but that's where tax planning comes into effect. Let me talk a little bit about Social Security benefits. I'm not going to spend much time here. Those of you that get your statements, you see that when you get your statements from Social Security Administration, it's going to give you three numbers: your primary insurance amount that you'll see there, the $1,680 in this example, your benefits at age 70, which is the longest time that you should wait or can wait to take distribution, and then your benefit at age 62, which would be your earliest. As part of the Social Security benefits report that I do for all my clients, what we try to figure out is what is the optimum time to take distribution. It may not necessarily be waiting till age 70, or starting at age 62. It could be anywhere, any year in between, because of tax ramification when it comes to the torpedo tax that we will talk about in the next few minutes. So it's important to note that. By the way, for those of you that have not received a Social Security statement in quite some time, please feel free to go to www.ssa.gov, and then you can apply at the Social Security website, and then you can pull your Social Security statements anytime that you want. So again, www.ssa.gov. Now, let's talk a little bit about torpedo tax. The torpedo tax is a very critical one, because if you don't do this correctly, there's a very high probability that you and your family are going to run out of money 5 to 8 years sooner than expected. And the reason for that is simple. If your Social Security benefits are taxed, any taxation of Social Security benefits is going to create a hole or a gap in your finances. And the only way that you're going to be able to fill that gap is to take more and more money out of your retirement accounts in order to plug that hole. And if you don't do it correctly, then those numbers are going to get bigger and bigger, which means that now you're going to be depreciating or depleting your retirement assets quicker than not. Now, whenever somebody gets ready to take Social Security benefits, every single year thereafter, I have to do a provisional income calculation. And this is something that your accountants should be able to do for you. The challenge is that there's a major difference between tax preparation and tax planning. You know, most accountants do not have the ability to do tax planning. They can do tax preparation, and most of them are going to do it very well, but they're not going to do tax planning for you, and this is where we come into play. So the way that the calculations are done in order to determine what percentage, if any, of your Social Security benefits will be taxed is that we would take for that year when we get ready to do your taxes, or before we do your taxes, so that way we can prepare accordingly. We're going to take the forecasted Social Security benefit that you will receive for the year, or that you have received for the year. We're going to take 50% of that. To that, we're going to add all the ordinary income that you have coming to you. So if you continue to work part-time, or if you had a full-time job, or you're still working after retirement and taking Social Security benefits, any distributions that you have had from your IRAs, 401ks, and whatever it may be, gets added on to the ordinary income, and finally gets added on to the provisional income calculation. We also need to add dividends and capital gains. So although your capital gains may be taxed at a lower rate under federal law, they get added on to the provisional income calculation to determine if your Social Security benefits are going to be taxed in retirement. And then last but not least are non-taxable interest. And primarily non-taxable interest are interest that you receive from municipal bonds and municipal bond funds. Yes, municipal bonds and municipal bond funds are federal income tax-free, but those distributions get added onto the provisional income calculation to determine what percentage of your Social Security benefits will be taxed in retirement. In reality, there are only 3 vehicles under the IRS code in which there is no tax liability when it comes to your Social Security taxation. Those would be your Roth IRAs, your Roth 401ks, and your 7702 plans, which are your cash value life insurance programs. You could be generating $500,000 of income out of Roth IRAs, Roth 401ks, and 7702 plans, and it will have no negative impact on your Social Security benefits. So your Social Security benefits would not be taxed. And most important, if you really want to, you would qualify for Medicaid and food stamps, because that benefit does not get included in your tax return at the end of the year, okay? Now, going back to the provisional income calculation, after we put in all those numbers that I just covered, if you're single and all those numbers are less than $25,000 in income for the year, then you pay no taxes on your Social Security benefits. If it is between $25,000 and $34,000, then now 50% of your Social Security benefits are going to be taxed. And if that income exceeds $34,000, then now 85% of your Social Security benefits will be taxed. But what if you're married filing jointly? Well, the rules are pretty much the same. If you're married filing jointly and your income, your combined reportable and taxable income is less than $32,000, then you pay no taxes whatsoever on your Social Security benefits. Between 32 and 44, up to 50% will be taxed, and anything north of 44,000, up to 85% of your taxes will be taxed in retirement. Now, that brings me to a very critical issue. And this is where the vast majority of Americans are making major mistakes. There are 3 taxable buckets. Financial tax buckets as far as the IRS code is concerned. You have your taxable bucket, your tax deferred bucket, and obviously your tax-free bucket. And the way those buckets work, the taxable savings accounts, your CDs, your mutual funds, the reason why you know it is in the taxable bucket is that every year the financial institution where you have your funds deposited in are going to send you a 1099, which is reportable every year for income tax purposes. That income is going to be reported on your provisional income calculation. Now, your tax deferred bucket, most of you know what they are, that your tax deferred bucket are your 401ks, your IRAs, and so forth. The money goes in pre-tax, money grows tax deferred, but then when you pull the money out, you're supposed to pay taxes on everything. That distribution that you take every year when you're in retirement will get added onto the provisional income calculation. And then last but not least will be your tax-free bucket. That would be your Roth IRAs, your 401ks, your 7702 plans, and your municipal bonds. But notice that I have an asterisk under municipal bonds because at the end of the day, they do have a negative impact on your Social Security benefits, but the other three there on the right-hand side do not. So what we try to do from a tax planning perspective, and you only have a 7-year window in which to properly prepare yourself for the future tax increases, is we want to make certain that you have the right balance between the taxable bucket, tax deferred bucket, and tax-free bucket. Sadly enough, the vast majority of our clients that I engage for the first time, obviously once they start working with our firm, those things change dramatically. But the vast majority of clients that come to see us and I do audits for the first time, most of their money happens to be situated between the taxable and tax deferred bucket. Now, I'm finalizing the presentation today, so hopefully this has been very exciting to you. But now I'm going to share with you, I'm going to put my reading glasses on, I'm going to share with you how to legally avoid the torpedo tax in retirement. If you do it the right way, how can you legally divorce the IRS in retirement? Because always remember, there's a big difference between tax avoidance and tax evasion. You can do all the tax avoidance that you want, but once you go over that line and you do tax evasion, you'll end up in jail. So, you know, the job that we do as tax planners is to make certain that we can maximize all of those tax benefits that the IRS actually legally gives each and every one of us every year, but we don't want to pay any more than we have to. So I'm going to walk you through an exercise, and this is part of the tax planning software that I would use for each and every one of us, each and every one of you that may want to engage me and my firm in doing some tax planning. And by the way, this first report, as I stated at the very beginning of the workshop, is something that there is no cost or obligation on your part. This is part of the SOFA financial education program that we offer not only on a webinar basis as you're watching today, but also through seminars at colleges and universities. So let's take a look at a husband and wife. They need $50,000 in income. And they walk into my office. This is an actual case, by the way. They walked into my office. They have $50,000 that they wanted to pull out. I'm doing their tax audit for the first year. Obviously, there are no names here so I can protect, you know, all my clients, because everything that we discuss is confidential in nature. But they came into my offices thinking that they're going to be taking $50,000 out of their IRA distributions, at least for a few years, in order to maintain their standard of living, because that's all that they needed. Now, when you do the tax map that I did for them, notice that the $50,000, and let me see if I can use my annotation so you can see my cursor as I walk you through this. Okay, perfect. Notice that if they take $50,000 of distribution out of their IRAs, they would be in the 12% marginal tax bracket. But the actual tax that they pay is the effective tax rate. So in this case, the $50,000 of IRA distribution has a total tax liability of $2,430 and an effective tax rate of 4.86. The difference between the marginal tax rate and the effective tax rate is that the effective tax rate is the actual tax that you pay. Because although the $50,000 ended up, the last dollar ended up at the 12% marginal tax bracket, notice that for the first $26,600, these clients didn't pay any taxes whatsoever under the new tax law because of the standard deduction. Then from there, they went to the 10%, and then they paid taxes for a portion of their income at 10%. And then finally, they paid a small portion in taxes at 12% on that income. So that's why you have the difference between the 4.86% and the 12%, which had a tax liability of $2,400 and $30,000. When I had the conversation with the clients, they were very excited. They thought that it made a lot of sense for them to take $50,000 just out of their IRAs and only have to pay $2,430 in taxes. So I said to them, look, you know, what if I have the ability to make this better, okay? What if I have the ability to make this better? And they said, okay, well, what do you mean? I said, well, what if we can just take Social Security at this point in time, and we can combine a Social Security distribution with IRA distribution, and let's see if we can improve that tax liability. I know you weren't too concerned about paying $2,430 under the first scenario, but what if I can improve it? So I did some calculation, and I came up that I could pull $35,000 out of Social Security benefits, and then only $15,000 out of IRAs, because clients only need $50,000. By doing so, all of a sudden, they're pulling the same in the red, as you can see here. They're pulling the same $50,000 of income, but their tax liability is now zero. So their effective tax rate is zero. So I just saved the clients $2,430 for that given year. What can you do with $2,430? Well, that's a couple of $100 a month. You know, that could be a utilities payment, that could be a car payment, that could be an extra weekend, a nice vacation, a little vacation, a long weekend. You can put that money into savings. There are a lot of things that you can do along those lines. So the clients all of a sudden started to open their minds to the possibilities. What I can tell you from doing these calculations for so many years is that when it comes to retirement distribution planning and cash flow, always remember that not all income is created equal. But let's see if we can continue to improve this situation. Then I said to the client, look, if we were able to pull $50,000 at no taxes whatsoever, the next question is, how much more money could we pull out of your IRA account, because we have been able to use an economic straddle, which takes into consideration a portion of distribution from your Social Security benefits and a portion of distribution from your IRAs. How can we leverage that? And if you notice here, I'm still taking my $35,000 of Social Security, but now I went up to $22,000 of IRA distribution. So I'm not taking $15,000 anymore for a total of $50,000. I'm actually now taking $57,000, an extra $7,000. And notice that I just took $57,000. I still have no tax liabilities whatsoever, and my effective tax rate is zero. So in this situation, just by doing some economic straddles, I'm able to get the client an additional $9,430 of money in their pocket at a zero tax rate. Why $9,430? Well, the $7,000 extra that I'm pulling out of IRAs that are net to the client's tax-free, plus the $2,430 that the clients now do not have to pay on those original $50,000. So they have an additional cash flow of $9,430. Clients couldn't believe it. Clients kept saying, Bert, this cannot get any better. I mean, this is incredible. You know, we never thought about it this well. What no one ever does. Your accountant doesn't. Your tax preparer doesn't. Unless you do proper tax planning and you can do tax forward planning, there's a very high probability you're going to be paying taxes on amounts that you shouldn't. But also bear in mind that in the following. Remember I said to you that the tax deferred bucket, the money that you put into your 401ks and IRAs, you put the money in pre-tax, the money grows tax deferred, and then you pay taxes on that distribution. Well, Bert, you told me that a little while ago, but now I'm able to pull money out of my IRAs and pay no tax liability whatsoever. And the answer is absolutely. But unless you do proper tax planning, the probability you're going to be able to take income from your IRAs and your 401ks without any tax liability is going to be slim to none, especially when you get to your required minimum distributions at age 70 and a half. So there's a lot of tax planning that needs to be done where you can move monies to Roth IRAs. You can have investments that you put into your Roth IRAs, your Roth 401ks, your 7702 plans. You can do Roth conversions. But if you're going to do Roth conversions from traditional IRAs to Roth, you have to do tax planning to make certain that you can mitigate those taxes that you're going to have to pay today in order to purchase that tax-free ticket for the rest of your life. But let's continue with the exercise since we're approaching the end of this webinar. Now, the next issue that I have with the client, I said, look, when you first walked into my office, you were going to pull $50,000 out of your IRAs. You guys were excited and very happy to the fact that you were only going to have to pay $2,430 in taxes, and you would have done that every single day of the week without any problem whatsoever, because then you would have netted, you know, the difference between that tax liability and $50,000. So although now we have been able to pull $57,000 out of your, as you can see in the previous slide, although we now have been able to pull $57,000, an extra $7,000 plus the $24,000 that we avoided paying in taxes net in your pocket. Now the next question is, well, how much more money can we pull, and to the point that we can get to that $2,430 of taxes that you would have paid at the very beginning anyways. So this would give you a lot more cash flow. And when I did the calculations, if you notice here, I was able to pull an extra $21,000. So instead of generating $50,000 and paying $2,400 in taxes, I am now able to generate $71,000, an extra $21,000, and only have a tax liability of $2,436 for an effective tax rate even lower, which is 3.43%. Now, you may say, well, Bert, I don't need those extra $21,000, or actually, after tax, it would be $20,994. I don't need that extra money. Okay, that's fine. Now, you could take a bigger vacation. You can take that money, put it into savings. The question that I ask all my clients is, look, if you can pull a lot of that money from your IRAs, that you in your 401k, so you were supposed to pay taxes anyways, if you're able to pull that with either no taxes whatsoever or minimum taxes at best, why wouldn't you do it? As a matter of fact, if you don't need that money, then why don't you do a Roth conversion and pull that and put that money into a Roth IRA, and now you have tax-free liberation and a tax-free revolution for the rest of your life. So if you did it the right way, and if you do proper tax planning, you were able to put money in your IRAs and your 401ks on a pre-tax basis, have the money grow tax deferred, and then pull the money out tax-free, and then put it into Roth accounts that would generate tax-free income for you and your family for the rest of your life. And by the way, the more money that you have in your Roth side of the house or the 7702 side of the house, the better you would be in fighting the required minimum distributions, because required minimum distributions do not, and I repeat, do not apply to your Roth accounts or your 7702 plan. So you can actually create a Roth account and 7702 portfolio that you don't have to invade until your mid-70s, until your late 70s or early 80s, or never, depending on your goals and objectives and needs along those lines. Now, the next quick exercise, so we can finalize this webinar. What if you have $50,000 in long-term capital gains? Well, $50,000 in long-term capital gains, again, have a 0% tax liability. So I re-emphasize a point that when it comes to your retirement distribution planning, not all income is created equal. Let me make it even better for all of you on this call. What if you have $50,000 of long-term capital gains, and let's say $50,000 of IRA distributions? Remember, that was the first number that the clients came to see me with, that they were going to pay $2,430 in taxes. Check this out. Now you have $100,000 of revenue for the year, reportable income for the year, but the tax liability remains at $2,430. That's a 2.43 effective tax rate compared to a 12% marginal tax rate from a business perspective. So see, if you don't do tax planning, you're never going to know how to manage the distribution of your assets in retirement. And it's a new phenomenon. I know that. I get that, because at the end of the day, none of us have ever had to deal with unless you're entering retirement. Now, the call to action to finalize this webinar, the call to action is simple. If you feel, number one, you have to avoid the definition of insanity, which is like rearranging the chairs on the Titanic. You know, the definition of insanity is doing the same thing over and over again while you're expecting a different result. So you need to try to avoid that as quickly as possible, because you only have a 7-year window in order to minimize your tax liabilities in the future. The second part of this webinar, if you feel that, you know, creating a tax planning report and a Social Security report for you and your family at no cost and no obligation, by the way, because this is part of the SOFA, the Society for Financial Awareness educational program that we offer. If you feel that's suitable for you, then go ahead and schedule a 30-minute video conference with me, or a conference call. It would be anywhere between 20 and 30 minutes, depending on, you know, the issues that you may want to discuss. Again, no cost or obligation. And obviously, you can feel free to reach out to me. So I'm going to leave this on for a little bit, so you can take a picture of it. If you have your cell phone next to you, you can write it down. You can call me at area code 786-766-1042. You can also email me at Bert, B-E-R-T, at GablesTaxGroup.com. And also you can visit our website at www.gablestpg.com. But it's important that you take advantage of these benefits. And by the way, when I do these, as I always say, there's no cost or obligation. Many of the people that I do this for, they actually end up allowing me to do their tax planning and their tax preparation while they do everything else with someone else. That's okay. But if you don't have the type of advisor or the type of accountant that can do tax planning and retirement distribution planning, and you may want to use our services, and obviously you have the ability to do so. So that's something that's very, very important. Obviously, I want to thank you all for giving me a few minutes of your time today. And again, this is an abbreviated version, because when we actually do the workshops at FIU, at Florida International University, both in the Miami campus and also the Fort Lauderdale campus, then we go deeper and we do a deep dive into all of these topics in order to assist each and every one of you. But I think this one here gives you a pretty good flavor of all the opportunities that all of you have available to you. Always remember that my number one goal, whether you're in front of me on a one-on-one basis or we're doing this over the web, my number one goal and that of my firm is to kind of help each and every one of you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thanks so much for giving me a few minutes of your time. Enjoy your weekend. We'll talk soon. Take care and have a great day. Take care. Bye-bye.